Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. As always, I am excited for this episode.
Yes.
And I think it's apt that you start your intro there with, we explore what's possible in the world of investing. And I think one thing that we have wanted to really drill into Australians over the years is that if you want to invest in property, there are other ways to do it other than getting a $1.2 million mortgage and spending the majority of your life trying to pay it off.
Big time.
There is a listed property available that you can invest in the same way you invest in shares. And today we're speaking to the co-CEO of one of Australia's biggest property investors.
That's it. We are speaking to Jason Huljich from Centuria Capital. They are an ASX 200 listed real estate fund manager. And today we're going to be looking at some of the key trends that are currently playing out in the commercial property space. We know office spaces have struggled since COVID. We know there's been a huge rise in demand for data centers and industrials. So we're going to sit down with Jason and figure out where the opportunities are when it comes to investing in commercial real estate.
Yeah, because as we said, there are listed vehicles, and Centuria have two listed on the ASX. They have the Centuria Industrial REIT, CIP is the ticker, and then Centuria Office REIT, COF is the ticker. They also have a listed REIT in New Zealand, APL is the ticker over there. But when we were speaking to Jason, he mentioned that they have 140 funds. So we made him list them all. But I think, if anyone's going to have their finger on the pulse of what's happening across the Australian real estate landscape, it's someone who's overseeing 140 funds.
Absolutely. So a huge thank you goes to Centuria Capital for supporting this episode, helping us keep all of our content free here at Equity Mates as we explore all of the investing opportunities that are available out there for everyone listening. But Ren, I think that's probably enough. Let's get into it.
Let's do it.
Well, Jason, welcome to Equity Mates.
Thanks for having me.
So we want to start with an introduction to Centuria. For those listening today who are unfamiliar, can you give us a bit of an introduction to what Centuria does?
Yeah, no problem. So Centuria is an ASX 200 listed real estate fund manager. So basically, we buy real estate, all forms from office, industrial, retail, so shopping centres, agricultural, healthcare, so private hospitals, all the way through to also private credit. So we buy these assets, and then we own them in different vehicles where investors can invest into. So everything from listed vehicles. So a listed investor that wants to buy a share on the stock exchange, they can come into us as a fund manager or into our vehicles. So we've got an office REIT, which has 20 large office buildings in it from around Australia, valued about $2 billion. We've got a industrial REIT that's a $4 billion vehicle with 90 industrial logistics assets around the country. And then we've got about 140 unlisted funds. So some of these might just have one asset in it, might be one office building, and we have the clients come in and invest in that, all the way through to diversified open-ended vehicles that are unlisted, so they're not on the stock exchange, but they might have 20, 30, 40 assets in them as well. So investors, if they like a particular sector, can invest in a sector-specific vehicle, or if they like a particular asset, they can come in, or they can go into a diversified vehicle across different sectors as well.
Nice.
So we're keen to unpack, I think, some of the different sectors, some of the trends you're seeing, and we'll touch on some of those funds as we go around the grounds. But before then, just at a high level, do you have an overarching investment philosophy across all those funds and all those different sectors?
Yeah, look, when we started off, for a long time, we were quite specialised. So we were just in the office markets and just unlisted investors. We didn't have listed vehicles. And around 2014, we listed our first REIT, which is an office REIT. And 2017, we got into industrial. And we decided we'd need to start diversifying money for our clients, right? right? A lot of clients didn't just want office; they didn't want a particular vehicle type. So we wanted to give them more choice. So hence the different vehicles and the different structures. When it comes down to property, it's some basic stuff, and we've been doing this for 30 years. It's obviously location. When we look at an asset, no matter what sector it's in, is if the tenants move out, can we release it, or is it going to be really difficult? So it comes down to where it's located, the quality of the asset. What you've seen more and more, things like sustainability credentials. So especially government and some of the large global tenants, they're very interested in the NABERS ratings, which is your efficient electricity and water efficiency ratings and things like that. So it's, quality of asset, location of asset, how leasable it is, and then strategy around that. Like we've made a lot of really good profits for investors on repositioning assets. So we might buy an older office building, but we know we've got a plan to refurbish the foyers, refurbish the services to bring the NABERS ratings up, so it appeals to a greater pool of potential tenants, things like that. And then once we release it up, then we sell it for a profit. So it comes down to good real estate. If something's not well located, it's going to be harder to lease. You just got a smaller and smaller tenant pool of potential investors.
Obviously, we don't speak a lot about commercial real estate, but if you're looking to do a bit of a facelift on a residential property, you do a bit of a lick of paint and some new carpet. Out of interest, what are the sort of small things you can do to a commercial building?
Look, some assets are similar, right? Some assets we go into the foyers, we give it a lick of paint and put a new directory board in, and it's pretty basic stuff. But as we've got more sophisticated, bought larger and larger assets, and we own assets that are 400 or 500 million. It's a lot more complicated, right? So you want to get into the services. So it might be older air conditioning plant, for example, a very inefficient plant. So you want to put the latest air conditioning plant into the building, which is millions and millions of dollars. It's facades. It's it's the systems that drive the building. They're called building management systems. So all these things, buildings are quite technological. So as you've seen, tech evolve. A lot of these buildings evolve. So if you're buying older assets, there's a lot of money you can spend. Some that you don't see that are sort of behind the walls and in the plant rooms that can make a big difference to the asset.
So you've mentioned some of the different types of investments offered by Centuria. The REITs, there's 2 listed in Australia and 1 listed in New Zealand.
Correct. Yeah.
Is that a nod to your hometown?
Yes. It was interesting. I moved over from New Zealand when I was 21, and John McBain, my joint CEO, he moved over in the 90s from New Zealand, and we've never really thought about going offshore. All our assets were just in Australia for a very long time. And then about 5 years ago, an opportunity came up to buy the largest unlisted platform in New Zealand. It was about $2.5 billion of assets. And they had about 5,000 investors, individuals that invested with them. And it was a really high quality platform. And it was good. So we did a lot of work, but we know the markets well. We got very good relationships in the real estate industry over there. So we bought that and merged it in. So now that's the only country we've gone offshore, and it's been really successful.
So, and I think did you say earlier you have 140 funds?
Yeah, so we've got 140 funds.
Name them all.
we got
addresses.
Yeah, 430 individual buildings.
Yeah,
so this
is
we're sitting about $21 billion of assets. So we're one of the biggest in our space. 2,500 tenants, individual tenants. It's a big portfolio. We've got 13,000 investors across that portfolio, just on the unlisted side. So if you look at the listed vehicles, they've each got about 7,000 or 8,000 individual investors in those. Yeah. In the unlisted side, so our platform is say 21 bill. About a third is listed, so the vehicles we just talked about, and then about 14 billion is unlisted. So a lot of these single asset funds or open-ended funds, or we have some institutional investors as well. So we go right the way through from a young person investing in $10,000 into one of our funds, individuals into high net worths, into family offices, all the way up to some of the biggest institutions in the world. So we've got mandates and joint ventures with groups like we've got a big Asian sovereign wealth fund. We've got BlackRock. So BlackRock, as you guys would know, is the biggest fund manager in the world. Like, we sound quite big, 21 billion, lots. BlackRock has 11 trillion US. So it's 18 trillion US dollars. Now, only a small percentage is real estate, but they invest with us. We've got 2 vehicles with Morgan Stanley, one of the biggest global banks in the world. We've got Starwood, who's a huge US manager. But the good thing is, and what our investors like, is if some of these the biggest investors, the largest investors in the world are supporting you, you shouldn't be. Yeah. It's a good sign that they've done their DD and you know what you're talking about, basically,
So as well as all the actual property funds, you have real estate debt funds.
Yep.
And Australia, I think a lot of the investing world has been caught up in the private credit excitement. I was going to say mania, but that's pejorative. Excitement. How have you seen that translate in your debt funds?
Yeah, so we got into the real estate debt side 4 years ago, and we saw it coming. We saw there was a lot of demand. A lot of our investors were investing in it through other managers. And we found a small platform, only about 230 million of loans out, but the founders were really experienced guys. One of them had worked for UBS, one of the big investments banks, and he ran structured credit for them in Europe. He's an Australian guy. The other one had set up a lot of real estate credit businesses around the country. So they just started. They actually came to us and said, look, you've got this really strong investor base. Would you put some of them into our funds? And we don't usually put our clients into other funds, but we knew they were investing to credit. We really like these guys, and we thought, well, we'll put some of our own money and get a few clients just to test them out. So we did a few deals with them, and they were really good operators. And when things, one particular deal went a little bit off the rails, they came in, they managed it really well, got it back on track, and actually investors made more money than they expected. So we liked how they worked. So we approached them and said, well, we want to buy half of you. So that was 4 years ago. Now that business has grown from 230 million of loans out to developers and real estate investors, 2.3 billion in 4 years. So been a huge success. What you've seen in that sector is, if you look around the world, it's been quite different to Australia. Australia got 4 big banks that dominate real estate lending. Basically, they had nearly all the market. You've seen over the last 5 years that share dropped from in the 90s down to the 80s, percentage-wise. As banks, APRA's made it a bit harder for the banks, so reserving and what they can and can't lend into. Banks being big beasts, they're not flexible when they're working with a lot of these developers, and they have set metrics of pre-sales, timing, things like this. So what you've seen evolve is you've seen a lot of developers and real estate owners, if they have something a bit different and they want a bit more flexibility, they go to the non-bank lenders. And so it's grown significantly. We're still a long way behind percentage terms, the US and other countries. So I think there's still a lot of runway, but there's a place for the banks and there's a place for the non-bank lenders as well. And it's definitely been a really high growth part of the market.
Well, we want to dig into some of the trends that are playing out in commercial property. And I think there are two different sectors over the past sort of, 5-10 years that have had a really, divergent fortunes over as I said, the sort of the past few years. There's the commercial office space, and then you've got the industrials and the logistics. Let's start with the positive side of things. Can you give us a sense of the supply-demand imbalance that is playing out in the logistics space?
Yeah, so logistics. So we started in this sector in 2017. We bought a small listed vehicle, sort of had about 600 million of assets in it. It was quite untidy, some older assets and things. We started cleaning it up and we started buying more high quality stuff and really actively asset managing the assets. Anyway, that vehicle's now 4 billion. Across the portfolio, we've got about 6 billion of industrial Australia and New Zealand. So we know the sector well, about 170 individual assets, right? That sector's been extremely strong since COVID, right? So if you go back, when I first started in real estate, industrial, you could probably get a yield of 13, 14%. Rents hadn't moved for 20 years. They didn't move for 20 years. Very low growth, but reasonably high return sector. Leases were quite short, so leases were 3 years probably. Now, what's changed in the last sort of 5 years? So COVID pushed a lot of people online. So as you've seen online retail expand and get up to, I think Australia 13%, 14%, other countries in the world 20 to 30% of retail sales, all of them need warehouses. They don't need stores, but they need warehouses to get their goods to people and get their goods to people quicker and quicker. When we were all happy to wait 2 weeks for something 5 years ago, now you want it that day, in an hour, whatever. Anything past a day is hard. So they need warehouses closer and closer to high density parts of the population, basically. You're seeing huge demand for particularly what we call infill logistics. So sheds that are closer to the CBDs, closer to where people live, right? Historically, you had big sheds being built on the outskirts of cities where the land was cheap, it was industrial zoned, but you've seen that demand come closer and closer. So what you saw in the Australian industrial market was world record low vacancy. So in Australia, 12 months ago, vacancy got down to, in New South Wales, 0.5%.
Wow.
So normal vacancy in any sector is sort of 7 to 10%.
Oh, wow.
So 7%, you should still be seeing rental growth in your assets. So when it gets to 0.5%, you think people are always moving around, right? So there's something vacant always. So to get to 0.5% is nearly impossible, right? So that means basically every single shed is full, and there must be a lot of people wanting more space. So you saw huge rental growth. So for 20 years of not much rental growth, rents went like this. So to give you an example, we've seen rents go from $115 in some areas of Sydney to $330, right, in a very short period of time. So just imagine what that does to the value of your building, right? So you're getting 3 times the income. So, our releasing, what we call releasing spreads. So every 6 months we release our releasing spreads. So that what that is every lease that came up in that 6-month period, what was the average rental increase from the day before we changed it. So this is when rents come to the end or the market reviews come up. And for December 31, just gone, it was 50%. So if you were paying $1 million for your shed and rent that day and your lease came up and you re-signed the next day, you're paying $500,000.
Wow.
Right? So it's just it's meant a lot of focus on industrial, a lot of investors coming in from offshore and obviously onshore investors, huge rental growth, huge returns in that space. You are starting to see it moderate, right? Around the world, Australia is still probably the best. They've still got the lowest vacancies in our major cities, and if you look to the States or Europe, but instead of being say 0.5%, we might be 2.5 to 3, which is still really, really low.
Is there much opportunity to increase capacity in the areas around here? I imagine there's not just vacant blocks of land that you can throw a shed on.
And that's the thing, there's always land being opened up on the outskirts of town. Even that's been difficult, and that's caused a lot of issues in the Sydney market is infrastructure. So you've got a lot of land that's been zoned industrial out, if you go out to Mamre Road, out towards the new airport, out that way. You've seen a lot of sheds come up, but all the new releases don't have water, don't have power, don't have roads.
Oh, wow.
So that's really, really pushed out a lot of the developments there. Well, usually when you get really, really tight vacancy, you get a lot of supply coming into the market. So people build because they can make big profits in it. But that infrastructure issue has caused big issues and meant that a lot of stock hasn't been built, so it's kept it low. Now, when you talk about infill, so this is stuff within the ring, the Sydney ring, again, you don't have land, right? So to build something, you'll knock something down, basically. So it's a lot harder to get supply into those markets. So those markets are held up very well. So if you look at the differentiation of returns and vacancy between what we call infill and, let's say, outside. In the last 6 months, infill vacancy is about 1.8% versus the other stuff further out is about 3.3%. This is just Sydney. Rental growth on the infill has been 8.9%. Rental growth on the outside has been about 4%. So it's performing a lot better just because it's more tightly held. And what you're seeing, which is interesting, we're going down the way of some of the Asian countries. So Asia for a long time in really highly dense locations have been building multi-level industrial. So historically, industrial has always been one level shed, like a big shed. It might be 5,000 metres, it might be 50,000 metres, but it's one level. What a lot of the Asian groups have had to do, places in Hong Kong particularly, but also China, Singapore, is built up. So you have these big warehouses, but they're stacked. So they might be 2 levels, 3 levels. There's warehouses in Hong Kong that are more than 10 levels. Wow. So imagine a warehouse where you need a big roof height for pack, and you got these massive ramps because you got big trucks coming in, right? I was going to say,
how are you getting semis up
Huge
and down?
trucks. So if you go to, next time you go to Hong Kong, if you go, just coming out of Hong Kong towards the airport, you'll see this Goodman, which is one of the biggest industrial companies in the world. It's Australian. You'll see a big Goodman sign and you'll see this huge structure with these huge ramps going up either side, and it's a warehouse. So you're starting to see that in some of the infill areas such as South Sydney. So obviously South Sydney is a really high demand area for logistics because you're close to the port and the airport. Right? So the highest rents in Australia are South Sydney. So, and you've seen a lot of residential development and a lot of industrial land getting taken out, right, because of rezoning. So If you really need to be in that area because you're highly reliant on the port or the airport, what we're seeing now is the only thing that works is going up. So you're starting to see that sort of thematic come into the Australian markets as well.
Wow.
So I imagine adding to the challenge here with these sheds is the AI and data center demand that also wants similar shaped sheds in similar locations. Has that just been put a rocket fuel under demand?
Look, it's interesting. For data centers, it all comes down to power, right? So with industrial, a lot of users don't need power, like if you're storage or, you're just moving goods around. Some manufacturers do need a lot of power. So there are some sheds that have access to a lot of power. But yeah, there's definitely industrial areas now that you're seeing data centers be built. We got into data centers recently. We've owned data centers in our industrial REIT, actually. So we have one of Telstra's largest data centers in Clayton in Victoria, which is sort of a $500 million asset. It's a big asset. Wow. And that's a long-term lease to Telstra for their needs. We own another data center in Perth. But we started looking at data centers and how can we compete in the space? There's a lot of big operators from around the world, the big hyperscalers, as we know, Amazon, Microsoft, Google have these. And what you've seen is them building these massive structures. And we started talking to a group that specialized in smaller data centers. So they had technology that was called liquid immersion. Basically, most data centers are air-cooled, so air-conditioned, right? And they need heaps of air conditioning to cool down the servers and in particularly the chips in these data centers. What you've seen is groups like NVIDIA that are building these faster and faster and more powerful chips, started with gaming and now for AI, means they get hotter and hotter. And it's basically got to the point where the new chips can't be air-cooled. It's just not efficient enough, right? So we invest in this company that has these tubs, basically, and you get the server rack and put it simplistically, you're putting it into a liquid. And it's a synthetic polymer, and you just cool the liquid, and it's a lot more efficient than air conditioning. The other good thing is you can pack 10 times the compute in the same area. Yeah. Right. Wow. So if a data center needed 5,000 meters for the data hall, we could do 500 meters. So the size of your office, we could do a data center. So we're putting one into one of our office buildings in Melbourne at the moment. It's quite interesting. It's our first one. And it's purely AI. So this will be the most powerful chips NVIDIA make in an office building, just taking a part of a floor to be a AI data center. So it's quite interesting. We're getting into that space. Yeah. You've seen this massive trend of data centers getting bigger and bigger and bigger. We think, especially for AI, you'll see them coming back the other way. What these big groups like NVIDIA are doing is, because they're doing these more and more powerful chips, you can get a lot more in a rack than you used to get. So if you go back 5 years, in a rack you might have 15 kilowatts. That's the power generated for these chips. Then it went to 30. Now you're seeing about 100. NVIDIA is saying within 2 years you get to 650 kilowatts, and within 5 years you get to 1.2 megawatts. Now, 1.2 megawatts historically would have been hundreds and hundreds and hundreds of meters, and they're saying that you'll get this in a structure that's half the size of this room. Yeah. So things are changing, so it'll go back the other way. But yeah, you've seen DC operators look at industrial land, but there's still there's a lot of industrial land. So I don't think it's affected the market that much, but it's definitely been a sector that a lot of capital has poured into.
Well, I think using the office space to trial this sort of new data center is a good segue into unpacking what's going on in that part of the market, because obviously ever since COVID it's been pretty slow. Can you give us a sense of where the market's at when it comes to offices?
Yeah, so work from home, COVID obviously affected office in a big way. In Australia, nowhere near some of the other countries like the US, right? Yeah, office has definitely been the toughest sector. You've seen most companies bring in some sort of work from home, and it's continually evolving. Like, look, most companies in, say, real estate are usually 3 and 2 or 4 and 1. So 4 days in the office, 1 out. There's other, obviously, tech, and others are, not much in the office and mostly work from home. And so there was a bit of a reset of tenant needs over the last 5 years. It's definitely stabilised. Nearly every office lease has come up in the last 5 years since COVID. So if people need less space, they've taken their less space and they've made the call. You've seen a real change, and you've seen the fit outs evolve. So where it was just lots, hundreds of workstations for a big company, now they've got these collab spaces. They've got things for town halls. They've got a lot more amenity for their teams. They want to bring, a lot of companies want their teams back in the office and are struggling. No, most private companies can just say get back. Government struggling, banks, big financial services company, insurers, things like that have struggled to get people back. Around the country, cities like Brisbane, Perth that didn't really have lockdowns, they're back to normal. Melbourne, that had the longest lockdown in the world, definitely a different mindset of getting people back in the office down here. Sydney, probably in between, right? Sydney's definitely improving. And it comes out of the different parts of the city. Like if you're in the financial core, so this eastern side of the city where it's investment banks, financial services, funds managers, it's pumping. Every cafe's full. If you're down the western corridor, which is more insurance companies, banks and stuff, it's a bit less busy, right? So it's definitely we've seen it stabilise. It's less and less of a thing in the market. Probably we've seen, as the economy's come off, you've seen demand, slack off for office a bit. So look, our office portfolio, we're sitting about 91, 92% occupancy, so still pretty high, right? If you think 7, 8's probably normal. So what you are seeing suffer are the older buildings. So if you're a B grade or C grade building that's not energy efficient, that doesn't have big floor plates for your tenants, doesn't have good amenity for your tenants, like you're putting a lot more things into to get them to work. So gyms, so free gyms for your tenants, what we call last mile. So a lot of big change rooms and areas for people to cycle in and bike storage. And, we run a lot of programs across our office buildings where we run yoga sessions during the week. We run spin classes. We run all these different things to get people back into the offices, basically. And most sophisticated landlords are doing that. So the end of trip facilities where these people, need to change, need to do all this stuff, are just growing and growing and growing. So it's adding amenity to these buildings. So what you've seen with office demand on the investor side is drop off, right? So you haven't seen much until recently, investor demand from offshore buying offices and the like through this period. You just don't see that turn. So put it into context, we value all our assets basically every 6 months. And then we release to the market, what went up, what went down and so forth. To 31 December, across all 430 assets, vals dropped 0.2%. So basically dead on still. Now, give you the bookends, industrial went up 1%, office was down 1%, everything else is pretty stable, right? So everything's stabilised on vals. You've seen office vals trend down through this period, but now they've begun to stabilise, which is good. And probably in the last 12 months, you've seen quite a few large office transactions in the Sydney CBD be announced with offshore groups coming in and buying office assets, which wasn't happening. So big Japanese groups, big German groups coming and buying assets. So the market sort of turned on the investor front as well for office.
So just with the story around offices, it's very much that things were good and then COVID hit and then things weren't great. Is that what you were saying as well? Were there any signs of this work from home trend stuff before?
Not really. Some companies had it to a small percentage, but when it came in, across the board and became a lot more common, that's what changed. But look, what we saw in the US was very different. They had other reasons not to go home. We sent our guys up the big tour of logistics and office up there, and this is just up to COVID. And the issue up there was also crime, right? So a lot of workforces didn't want to go on the subway, or there was massive homelessness problems, and there were, the guys went to some big buildings in San Fran where basically these people had taken over the building. They'd taken over the foyer, so less people came to work, and then they just started infiltrating in the building. So they had a lot of issues over there that made it a lot worse for them. In Australia, I think we've got through it pretty well, and we expect to see those vals hit back up. Occupancy to trend back up now. It's all been stabilised. All the companies have reset, and it was quite interesting. We've got a lot of assets, office assets in the suburban metro areas and city fringes, and we survey them all and see intentions of less space, more space. Look, over the last 3 years, on average, they've taken more space, not less space, than they had pre-COVID. So different sectors and different areas have sort of treated that whole thing a bit differently. It's been interesting. Yeah.
From a quality of asset point of view, what's the best office building in Sydney? Or what's the Vaucluse of the CBD?
What we call the financial core. So if you think of Circular Quay, up to maybe King Street, and then what we call Midtown, then you have South, and then over the other side of the sea on the western side is the Western Corridor. So the highest rents you get are in, I don't know if you know, Chifley Tower, Governor Phillip, Governor Macquarie, which is One Farrer Place now, Aurora. So on the eastern side of the city with fantastic views. So for example, Chifley Tower, we're in Chifley Tower. It's a 30-year-old building, but fantastic building. It's got a lot of amenity. It had 2 great restaurants. It had 20 shops in it. It had great parking, really good end of trip. So that is owned by basically Singapore government and a group called Charter Hall. They are actually They've knocked out a lot of that amenity and they're building a second tower there. So you'll have two huge towers. So this is once that's done, that's probably a $4 billion asset. Now, they're getting record rents in there. They're signing up some huge groups to come in. So, and that financial core, the occupancy is very, very high. So as I said, the further, if you go over the western side of the city, occupancy's down, rents are down. So yeah, even in a CBD, there can be a lot of different tailwinds or headwinds depending where you are located.
So we've covered logistics, we've covered data centers briefly, we've covered office. Are there any other like key real estate sectors that we haven't asked you about that we think you think
retail. Look, retail's interesting. So we've been buying a bit of retail. So we've launched a few what we call single asset funds. So as I said, we just buy an asset, might be a shopping centre. We'll go out to investors, and investors or financial planners can put their clients into the fund. And always with property, what you're after is an income return, and you can get a pretty good return off the income depending on what sector you're in. And I hope to see some capital growth. So, we can add value, or we've bought well and the market's going up. So retail we've really liked in the last probably 24 months because through COVID, what you saw was a lot of the retailers actually did quite well. So especially things like neighbourhood shopping centres. So neighbourhood shopping centres, which are a Coles or a Woolies with 10 specialties, let's say. Not really fashion focused, say your baker, your butcher, whatever, attached to those centres and the trade in those Woolies actually went up through COVID, right? So they all held their value and did very well. The other sector that we've actually seen perform well is what we call large format retail. So that's those big centres that have Harvey Norman and JB Hi-Fi and the likes in them. So those large format centres have done very well as well. So what we've been buying recently is neighbourhoods in large format, mainly in single asset funds. So we might have 200 investors come into a fund. Anywhere from 10 grand up to millions of dollars each. They get a monthly return from coming off the rent of let's say it's a Woolies and Coles and the others. And then it might be a 5-year fund. We're trying to add value to it. So then when we sell it in 5 years' time, everyone makes a capital gain as well. That's the plan. So yeah, retail's been really good. Large format, it's been interesting. And this is a thematic across all the sectors. What's happened through COVID, and everyone would know, is construction costs have gone through the roof. So to build anything or to renovate your home, costs are more than double, right? Now, how that flows through to commercial property in the sectors is to build anything, to build a new building, a new development, and there's always new developments on every sector being built, is a lot more expensive, which makes developments hard to stack. So it's hard to build something and make a profit. So if you're a developer and you want to buy an office building, for example, build an office building, rent it up, sell it and make a development profit. Give you an example. So pre-COVID, to build an office building, buy the land, lease it up, you might have been about $10,000 a metre to build a metro office building in Sydney. Do it now, it's $15,000 a metre. Right, so the rent you needed to get then was maybe $600 a metre. To make it stack, the rent you need to get is $1,000 a metre. Now, why is this good for property is it means you can't make a profit, so no one's doing it. So the amount of cranes on the skyline, the amount of new developments, it's just not happening in a lot of sectors, right, because it just doesn't stack. Now, what that means is normally you'd have all the supply coming in each year. It's not going to happen. So in 2, 3, 4 years' time, when no supplies come through, demand's still coming through. Immigration is a big driver of real estate, right? You just think of someone coming in, well, they need a house. Yeah, they do. But for every million people that come in, you need millions of square metres of office space, millions of square shopping centres, millions of square hotels. It's all these other things. Yeah. And it's very highly correlated, right? And immigration's still going. So you've got this huge demand tailwinds and you've got a supply headwind, which is going to be very good for a lot of sectors. And something like large format, as I was talking about, again, like industrial, not a lot of rental growth over 20 years because there's no new centres coming and a lot of the tenants want to expand, they'll pay up. So rents are really increasing as well. So it's picking some of these thematics when we invest where we think we're going to get good rental growth, because if you're getting good rental growth, you're going to increase the value of the asset as well as getting your monthly income return from the rent. And that's what we really want to do. A lot of real estate is a total return play where you want to get this income into your bank account every month, but you want this capital gain on the asset when you sell it as well.
Well, I think that's a good point to turn to how you invest across these sectors, and this is sort of where we want to close the conversation. And I think, we've spoken about a couple of sectors that have had divergent fortunes over the past few years. So how have you, as like a diversified property investor, thought about investing in, the hot sector in industrials, but also balancing that with like potentially the opportunities that are springing up in the office space?
Well, we look at both. We've got all sorts of investors, and they want all sorts of returns. We've got investors that just want an income return. Some investors want to take a bit more risk, right? So they'll go into something that might have some vacancy and needs to be repositioned, or a sector that's a bit tougher like office, but they'd expect a higher return to take some risk. So that's how we look at risk reward, basically. So you got an asset that's got a blue chip tenant, let's say government in it, and it's a long-term lease. Well, basically, you know the income return is going to keep getting paid. Government pays their rent. So you accept a lower return for that risk. If you've got a building that's empty, we have to refurbish it, we have to find a tenant, we've got to lease it up, you want a high return. So that's how it works. So, and it's a mix of investors, it depends if you want to take, you're younger, you're actually prepared to take a little bit more risk because you've got a longer term view, or you're an older investor, you're coming into retirement and you want safe, you want income coming out off that. So, and that's why we've diversified so much across obviously sectors, but also the types of vehicles, because some investors are suited to a single asset fund, and if they want diversification, they'll pick a few different ones. Others just want to come into a fund that is diversified. We do it on our real estate debt side as well, where we've got single loans that you can invest into, or you can invest into a fund that might have 50 or 60 different loans out there, so it's diversified. So different investors like different sorts of products, depending on, obviously their age, their wealth, lots of different factors.
And to close, Jason, what sets you guys apart? What's the elevator pitch if we're thinking about investing in commercial property between you guys and others?
Yeah, it's like any investor. You got to look at the manager, right? The manager of your investment, your fund. And a few things that I think we really tick the boxes, like track record. Like we've been around nearly 30 years, right? So we've been through all the different cycles. And real estate's very cyclical. So you have the up, down. So, there's probably some newer fund managers that have never been through that. And I personally learned most of my lessons through the tough times, GFCs, things like that, where it was tough, really tough. And you learn to deal with banks, you learn to deal with problem issues with assets and with tenants and things like that. So track record is super important. I think transparency or what information is the manager giving you on your asset? How is it to talk to senior people in the organisation? Now, we've got close to 500 people in our team. Any investor can email me, call me, ask me a question about any of those 140 funds. I'm open to it, right? We're not. We're set up like we're very transparent. We're very open. Not every investment goes 100% to plan. But what we learned, especially in periods during the GFC, what was tough in real estate was you got to be transparent to your investors. They don't want surprises. If you say, well, look, this tenant's got some issues, we're going to have some problems, but this is the solution, this is what we're going to do, they're fine with it, right? They don't want to surprise and just see something stop, their distribution stop down the track. So we're very transparent, so that's an important thing as well. One thing that we are a bit different to a lot of our peers is we have all our what we call property services in-house. So in our team of 500, we've got everything from facilities managers, who are the people on the ground at your building, looking after the lifts, property managers who deal with the tenants, and then we've got asset managed development, leasing, all that. But what a lot of our competitors would do would outsource the facilities management and property management to one of the big agencies, so Jones Lang or CBRE, and they let them do it. Now, why we do it is to have face-to-face contact with our tenants. So we know if they want more space, less space, don't like the building, do like the building, have an issue with the lifts, aircon's not right. So our people are speaking to our tenants day to day, face to face. So we think we get a better real estate outcome from having that hands-on approach. So we're really active managers on the properties. For example, if a tenant does move out, we've got the teams ready to go to get it leased up, to deal with the tenants, to move it. So that's probably a big difference as well. But if someone looking to invest, I think, look at the manager, look at track record, and just make sure they've been through a few cycles and they really know this stuff.
Nice. And where can people go to find out more info?
Yeah, look, if you go to centuria.com.au, it's they're on the website. It really goes through all our different types of vehicles, the different sectors, what's open for investment. A lot of our funds are closed end, so people have invested and we're just managing that asset. Others are open-ended, so we've got funds that are in healthcare, for example, or diversified funds where you can invest every day. You can invest from $10,000. And then we've got one-off raisings where we've got one at the moment. We're raising for a large format centre up in Brisbane, and that will have maybe a 6-week raise period where we get all the investors into the fund, we buy the asset, and then it's a fixed term funds. But that's got all the information on the site.
Yeah, nice. I was going to say I might want to get on that mailing list.
Yes.
Yeah.
No problem.
Well, Jason, that was very interesting. No doubt many listeners are now thinking about how they can add commercial property to their portfolio, rent included. So we really appreciate you coming in today. Thank you so much.
Thank you very much.
Thanks, Jason.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.